is that it's the non-financial companies that will dominate the space. Telecommunication firms, consumer brands, Ant Financial, WeChat. If you have two main attributes, you can offer any financial service. Number one is trust. Number two is consumers. If you have a huge number of consumers that trust you, you can offer financial services, Robo being one of them. The biggest trend I see is that there'll be a movement. Banks will still have a lot of the customers, but the biggest growth from 17, 18, 19 will be in companies that have now become financial companies because they have customers and trust. It's going to have the biggest impact on the people with the least amount of money. So the people with the most money will have the least impact. So if you're a billionaire, your relationship manager at the bank is still going to be the relationship manager at the bank. But if we think about this, finance is a bit messed up, right? The more money you have, the lower you pay, and the more advice you get. If you have a lot of money, you should pay more because you have more. Well, but that theory is right. But you should be more financially literate because you have a lot of money. If you have $10 today, you cannot walk into a bank with $10 and say, I'd like to meet a financial advisor to structure my portfolio. No one cares for $10, right? Whereas for a consumer who has $10 now, in America already there's a robo that will give you a globally diversified portfolio starting at $5 because they take ETFs and they fractionalize them. So they cut them into little pieces. So robo to the investor, the consumer, the impact starts from the base of people who have really not much access to investment or savings, and they will start to see that. Whether it's that in 17, but it will start. And the people who will provide that to them will not be the wealth managers. I don't think it's the telcos and the consumer brands. So already Korea Telecom has a banking license. Telecom Indonesia is acquiring a banking license. We see very clearly that it's the consumer brands who will start to provide simple savings and investment products. So the whole concept of fintech is look at finance and find out where the margin is high, not where the tech is bad. No fintech looks at a bank and goes, I wonder where they're making really low margins. Can I attack that? They're not. For example, telegraphic transfer. You know, when you send money abroad, you pay $20. I don't know what the right price is, but I've seen people on the blockchain do it for 1 cent. Now, if the banks were already charging 1 cent, no one would care, right? Why would we go after something that's already that thin? And if we look at wealth management, the margins are still high, right? A man in the street today pays 5% to get in, 1% annual, 1% exit. So there's 700 basis points in the first year if somebody exited, 600 if they stay in. Now, of course, that initial entry of 500 basis points is amortized over the length of the time. But I think it's clear to everybody that in the wealth management space, there's room for margins. So I think they'll face margins coming down. But in the same, what I said at the beginning, they can access a huge number of customers now. So I think from a wealth manager, they should embrace robo and basically say, look, yes, it's going to bring our margins down. Okay, understood that. But it reduces the amount of work we have to do on a one-to-one customer basis. We can focus on our high-value customers. And in theory, it opens up a huge new customer base. I'm sure when you say to somebody, oh, here's a new customer with $10, they're like, I don't want a $10 customer. But remember, that $10 customer is a millennial, right? And they're earning and they're growing and they're earning and they're growing. So they have to take a longer-term view that to access customers, to use a robo in different ways. So I think that's the effect. Every asset manager is going to have to realize that the way that customers stay with them and the amount that they charge, because remember now the transparency is huge, right? So 20 years ago, if you invested in funds, you didn't have real-time access to the prices, right? And you couldn't compare across everyone. Today, right? It's hard to charge for alpha or outperformance if you're not providing it, right? Because it's super clear, right? They will always be a regulator. They're here to stop people doing something that is against the regulations, 100%, and that will always be the same. If someone sets out to take money from a person for the wrong way, 100%, and they will always be that. But they've also been very clear to say that the regulations that we currently have need to be worked on to accommodate this changing fintech world, right? They don't have all the answers like nobody does. And I think all regulators are going to move at different paces. Hong Kong's looking, Indonesia's done a great job. And I think it's very challenging, right? I mean, look at this. Uber is a fintech company that just happens to have taxis. They're a payments company, right? So how should they be regulated? And it's super... Look, I think the regulators have a really hard job, but a really interesting job, right? It's a cool space. But the biggest thing I see from regulators is that they are evolving with it, and that's the best they can do.